Thanks for joining us at XM.com. The upcoming week holds important data releases and 2 central bank meetings, so it will be interesting to see how the FX market will be affected by these events. I'm Cristina Marujos. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, let's start with the United States. Non-farm payrolls are out on Friday. Forecasts point to another strong print. That, of course, would reinforce the higher for longer stance of the Fed regarding interest rates. But what could that mean for the US dollar?
Hello, Christina. We've seen a phenomenal rally in the US dollar lately. So it's a combination of the impressive rally that we've seen in US Treasury yields, solid economic fundamentals, and safe haven flows. And that combination has allowed the dollar to gain against the euro for 11 consecutive weeks now. So what's behind this strength? Well, in a nutshell, the United States appears to be much more resilient than any other region, where we've gotten a lot of US data lately and they continue to reaffirm the strength of the US economy. Now, in contrast, when you look at Europe, the region is going through a sharp economic slowdown. China is still dealing with the implosion of its property sector. So we are seeing a differential in economic growth, and that is increasingly pushing investors towards the United States. And of course, the massive rally that we've seen in US Treasury yields, it's also making the dollar more attractive from an interest rate perspective. So the dollar offers the full package right now. It has the higher real interest rates among the major economies, the strongest economic growth, and safe haven qualities thanks to its reserve currency status. And there's no real alternative. When you look at across the FX arena, every other major currency has its own problems. So the outlook for the dollar looks quite bright. The upcoming data that we are going to get are either going to add more fuel to this rally or they are going to trigger a correction. So we're getting the US employment data on Friday. The forecast is for another solid employment report, non-farm payrolls at 150,000. That's less than the previous month, but a decent number overall, Christina. The unemployment rate is expected to have ticked down to 3.7%, and wage growth is expected to have accelerated a little bit in monthly terms. Now, if all of these forecasts are met, it would be yet another data point that reinforces the Fed's message. Interest rates are likely to remain higher for a longer period of time. Now, for any potential surprises in this data, Christina, most of the early indicators we've gotten point to another solid month for the US labor market. Specifically, applications for unemployment benefits fell sharply in September. What that tells us is that there were no signs of any mass worker layoffs. And similarly, business surveys, the ones we've gotten so far, signaled the reacceleration in employment growth. So adding it all up, it looks like the labor market is still quite strong, and if the data exceeds expectations, it could add some more fuel to the rally that we've seen in the US dollar.
Now let's turn to the central bank front. The Reserve Bank of Australia meets early on Tuesday, followed by the Reserve Bank of New Zealand on Wednesday. No action is expected at either central bank meeting. So how could we see the antipodian pair perform this week, especially considering the slowdown we're seeing in China recently?
Yeah, so the Reserve Bank of Australia and the Reserve Bank of New Zealand are priced in a very similar way. The markets are saying there's about a 10% probability that either central bank raises interest rates. So the markets are saying these central banks are probably going to remain on hold, but there's an off chance they decide to surprise. So what's happening in those economies? Well, in Australia, recent data releases have been quite strong. The labor market recovered in August. Inflation reaccelerated a little bit. But the Reserve Bank of Australia has signaled that it prefers to keep interest rates unchanged for a longer period of time. So on the margin, they could sound a little bit more hawkish, but I don't think it's going to be a major driver for the Australian dollar. Now, in New Zealand, the interest rate decision could be more interesting because even though the probability for a rate increase is only 10%, the New Zealand economy has performed quite well lately. So inflation seems to be gaining momentum again. It inflation cooled a little bit in the second quarter, but the jobs market is still very tight. Record levels of labor force participation. We've seen an explosion in population growth lately, and combined, these are helping to boost demand. Now, in addition, the depreciation in the New Zealand dollar that we've seen in recent months, coupled with the rally in oil prices, will also help to refuel inflation, let's say. So, considering everything, the Reserve Bank of New Zealand will likely keep interest rates unchanged, but they could signal that another rate increase in November is on the table. And if they do that, the New Zealand dollar could gain a little bit. Now, having said all of this, the bigger factor for both the Australian dollar and the New Zealand dollar, as you correctly pointed out, is what happens in China. China is the largest trading partner of both Australia and New Zealand, so their currencies will be very sensitive to any developments in China. And in that sense, we are going to be getting the latest business surveys from China over the weekend. So depending on the results of those surveys, we could even see some gaps in these currencies when the markets reopen on Monday.
I see. Marios, thanks so much. This was The Week Ahead here at xn.com.